Listen to me. Listen to me very closely, because what I am about to tell you could be the most important thing you ever hear regarding your financial future. I've got a secret. It's been sitting right here on my desk, and it is absolutely time we dragged it into the light. You see this? This right here. This is my crystal ball. It's shiny, it's polished, and it promises to tell me everything the stock market is going to do tomorrow, next week, and next year. It promises to show me the peaks and the valleys before they happen. Look at me. If anyone, I don't care who they are, I don't care how many followers they have, I don't care what fancy suit they're wearing. If anyone tells you they have a crystal ball, you run. You run in the opposite direction. They are lying to you. They are not trying to help you. They are trying to pick your pocket. They are trying to sell you one of those get-rich-quick courses for $997 that will leave you with nothing but a lighter wallet and a headache. There's no magic ball. There is no mystical chart that can tell you exactly when to buy a stock right before it rockets into the stratosphere and makes you a millionaire overnight, if that existed. Do you think I'd be sitting here telling you about it? Of course not. But that changes your life. Even though there is no magic, there are certainly specific, calculated, deliberate things that I do to tip the odds in my favor. And today, I'm going to lay it all out for you, because you are part of the Money Game family now, and it is my mission to make sure you succeed. As I've grown older, as the hair gets a little grayer and the stakes get a little higher, I've found that truly understanding the reason behind why a stock's price shifts, understanding the mechanics of the machine, has helped me make money and, more importantly, save a fortune. If you are brand new to the stock market, I need you to understand one fundamental truth. A stock is not just a digital number on your screen. It is not just a ticker symbol moving up and down. A stock is a small, physical slice of a real-world company. When you buy that share, you are becoming a part owner of that business. You are buying a seat at the table. The goal, the entire objective of the Money Game, is to buy parts of companies that you believe in, companies that provide real value, so you can multiply your capital without doing manual labor every single day. But let's be honest with each other. It's okay to admit it. Investing can be terrifying. It can be confusing. It can feel like walking through a minefield blindfolded. Most people just pick companies on a whim, like they're betting on a horse at the track. That is not how we do it. That is not how we win. By the end of this video, you are going to know my exact strategies for picking stocks that have real legs. And don't worry, I am not here to sell you anything. There's no course, no hidden fee. So sit back, take a breath, and let's get to work. The two pillars, analysis. There are two primary ways to attempt to navigate the stock market. These are the two pillars, technical analysis and fundamental analysis. A great way to visualize this is like a balancing scale. Usually, short-term day traders, the people staring at their monitors for 8 hours a day, sweat dripping off their brows, are purely focused on technical aspects. These are the techies. They look at charts, patterns, candlesticks, and moving averages. They operate on the belief that they can predict future price action by judging the highs and the lows on historical graphs. They think if the line goes squiggly up, it means money. Now, look, I'm not saying they're wrong. I'm just saying that's not how I do it. That's not the Money Game way. My entire investment strategy, the philosophy that has kept me in this game for years, is about keeping it simple. It's about sanity. A lot of people on the internet will talk your ear off about using margin, about shorting, about complex option strategies. But I'm telling you right now, stay away from that. That is not something I worry about. And it shouldn't be for you either. I am a long-term investor. I am a marathon runner, not a sprinter. This means I am laser focused on the fundamentals of a company. I'm talking about the financials, the leadership team, the brand recognition, the competitive moat. I believe deeply that this is where the truth lies. This is where the long-term success of a stock is actually hidden. However, remember the scale. It is a balancing act. So, yes, I do pass my eye over the occasional chart. I check the technicals just to make sure I'm not buying at a ridiculous peak, just to find the best entry point. This balanced approach has helped me find some truly incredible investments over the years. It allows me to sleep at night. I'm not dipping in and out, stressing over daily price fluctuations. I'm building wealth. The most incredible thing, The majority of professional traders, with all their expensive software and fancy degrees, are still unable to beat a low-cost index fund over the long term. Let me show you why. Imagine this bucket in front of me. This bucket represents an individual stock. If I pump all my money into this one bucket, this one company, and that company hits a snag, that's all my money going down the drain. It's risky. It's dangerous. Now look at this other option, an index fund. Think of each cup here as a different company. By spreading my money across hundreds of companies, if one cup breaks, it doesn't matter. I've still got hundreds of others. It's safe, it's diversified, and it's one easy investment. My favorite index funds track the S&P 500. For those who don't know, that is the top 500 publicly traded companies in the United States. This is the heartbeat of the American economy. So, while the majority of my wealth is safely tucked away in these index funds, I still love the thrill of picking individual stocks to outperform the market. And you can too. And while we are on this subject, if you want to start this journey right, you need to join the community. The Money Game is where we grow together. If you aren't subscribed yet, hit that button now. Subscribe to The Money Game, activate the notifications, and make sure you are part of this family. We are building something huge here, and I want you at the front of the line. The quantitative deep dive. Right, so you're ready. You got your index funds. You're ready to pick some winners. But where you actually start, if you are anything like me, you start with the numbers. We call this quantitative analysis. Whenever I am considering investing in a company, I make absolutely sure to look at the cold, hard figures first. If the financials don't look good, if the math doesn't add up, it is very rare that I will waste my time doing further research. It's exactly like going on a first date with someone. On the surface, they might seem perfect. They're dressed well, they're smiling, they're charming. But it isn't until you really get to know the details, until you spend time with them, that you notice the flaws. Maybe they're rude to the waiter, or they eat with their mouth open, or they have no ambition. If only on that first date, they handed you a non-biased, comprehensive report on their character, their debt, their history, their potential, you could make an educated decision before you got your heart broken. I don't have a solution for your dating life, but luckily, that is exactly what public companies do. It's brilliant. They are required by law to publish their numbers. You can find this information for free on platforms like Yahoo Finance, which is a website I use religiously. There are three main documents, the big three, that I look at. 1, the balance sheet. First, we break down the balance sheet. I know, it sounds like a snooze fest. But trust me, this is where you find the juicy information. The whole purpose of this sheet is right in the name, to balance the assets against the liabilities. Think of it like your own personal life. You may own a watch, a car, or a rental property. Those are your assets. But let's say you have a massive credit card debt and a student loan. Those are your liabilities. The balance sheet tells us, is this company actually wealthy, or are they just drowning in debt? Let's break down the gobbledygook. Assets. These are divided into categories. Current assets. Things that can be turned into cold, hard cash within 12 months. Long-term assets. Things like factories, headquarters, or heavy machinery that they don't sell in a hurry. Non-tangible assets. This is fascinating. These are things you can't touch, like brand recognition, patents, or trademarks. Things that businesses have built up for generations. Think of Coca-Cola or Disney. Their name alone is worth billions. Liabilities. Here, I am interested in current liabilities. This is the debt they have to pay off within the next 12 months. If they can't pay it, the lights go out. There's a simple calculation you can do to see if a company is a high-risk bet or a fortress. Take the total current assets and divide them by the total current liabilities. My rule of thumb? That number should be above 1.0. If it's below 1.0, they have more debt than cash. That's a red flag. Let's look at a real-world example. Apple, if you take their total current assets and divide them by their total current liabilities, you get a number around 1.4. This is fantastic. It tells us that Apple could pay off all their short-term debts nearly 1.5 times over. They are sturdy. 2, the income statement. The second document is the income statement. You've heard the terms top line and bottom line? This is where they come from. At the very top is the total revenue. This is every single dollar that comes into the business. At the very bottom is the net income. This is the profit the company actually keeps after all the expenses are paid. Every business has expenses. Let's use a simple example. A neighborhood smoothie company. Their cost of revenue is the fruit, the milk, the cups. They can't make the product without buying that. That is an unavoidable cost of doing business. But then there are operating expenses. Who they hire, what kind of wages they pay, their marketing, their rent. These are choices. After these are deducted, you get the operating income. My calculation for a healthy business. Operating income divided by total revenue multiplied by 100. I look for above 15%. If we use Apple again, the calculation gives us roughly 27%. That is a healthy money-making machine. 3. The statement of cash flow. The last one, the big 3, is the statement of cash flow. I'm not going to bore you to death with this one, but I need you to understand it. The main thing I look for is if the company has increasing free cash flow year after year. This is the actual cash they can use to reinvest in themselves, buy back stock, or pay dividends to investors like you and me. A massive, screaming red flag is when a company shows negative cash flow, but they're still paying out dividends. It's a mirage. It's unsustainable. Eventually, the well runs dry. Don't be fooled by the dividend. Check the cash flow. Qualitative analysis. The secret sauce. Once I've done the math, once I've checked the vitals, it is time for the juicy stuff. This is known as qualitative analysis. This is where we look at the soul of the company. One of the big qualities I look for is brand recognition. When I say the word Apple, your brain doesn't think about a piece of fruit sitting in a bowl. You think about the phone in your pocket, the computer on your desk, the company that changed the world. That is brand recognition. It's power. Being a household name comes with incredible consumer trust. When they launch a new product, even if it's weird, even if it's new, people line up around the block to buy it. Think of the launch of the iPad. Everyone doubted it, and then it became an essential tool. This helps companies like Apple shape the future. Another great example, Coca-Cola. It is quite literally the second most recognized word on the entire planet after OK. When you have that level of brand awareness, you have an unfair advantage. Sentiment and the game of news. Now, something that creates massive volatility, something that can drive prices up or down in a heartbeat, is the news. I am always keeping an eye on it. Specifically the chatter, the rumors on social media. You remember the whole GameStop situation, right? A bunch of retail investors, regular people just like you and me, outsmarted the massive multi-billion-dollar hedge funds by spotting a flaw in their strategy. They squeeze them. They prove that David can take down Goliath. But here's the lesson. Once the news breaks, once it's on the nightly news and your neighbor's talking about it, the big profits have already been made. This brings me to the age-old saying, buy the rumor, sell the news. I learned this the hard way during the dot-com boom in the 90s. When I started, people looked at me like I was crazy for investing in these new internet companies. But 6 months later, everyone was doing it. My hairdresser, my grocery store clerk. Everyone was telling me about these dot-com stocks. I knew it was time to get out. I sold my positions to buy real estate just weeks before the bubble burst. I saved my profits. Others were not so lucky. Everyone thought internet businesses were the future, and they were right. But the companies were overvalued. I watched friends make millions on paper, only to lose 90% of their investment when the crash happened. It taught me that when the hype is driving the price, it's not a long-term investment. It's a trap. Leadership and the future. The next factor is leadership. In the age of social media, what leader says can shift billions in market cap? Look at Elon Musk. He is the visionary behind his companies. If Elon were to stand up tomorrow and tweet that he's leaving Tesla to move to Mars full-time, the stock would react instantly. That reliance on a visionary is a double-edged sword. It's a strength when they are winning, but it makes the company vulnerable to their personal actions. This leads me to a critical point. Always look for emerging industries. Look at electric vehicles. Look at artificial intelligence. My friend, always tells he believes that in the future, doctors might be augmented or partially replaced by AI in diagnostic settings. It sounds like science fiction, like something out of Star Trek, but technology moves faster than we think. I remember seeing the first electric vehicles years ago. They had a range of like 50 miles, and they were jokes. People laughed at them. But I watched that sector. I watched the shift. Think back to my youth. I remember sitting at my grandmother's house, watching a guy come to the door with a sack of coal on his back to heat the house. Imagine that. A man delivering coal. Today, no one does that. We use electricity, gas, solar. That sector vanished. If I had been stuck in the past, if I hadn't recognized that shift, I would have lost everything. You must ask yourself, is this company on the right side of the future, or are they the ones selling coal while the world moves to electricity? The strategy, dollar cost averaging. But how do you know when to buy? How do you time the market? You don't. Stop trying. You will never, ever perfectly time the market. There's a strategy, however, that allows you to win anyway. It's called dollar cost averaging. Imagine you decide to invest $1,000 every single month. Month 1, the stock costs $200. You buy. Month 2, the market dips and the stock is $150. You still buy. Month 3, it drops further to $130. You still buy. If you had tried to time it, you would have panicked and sold at month 2. But by sticking to the plan, you lowered your average by price to $160. You bought more shares when they were on sale. This is the beauty of buying the dip. Instead of getting scared, you treat it like a garage sale. You've done your research. You know the company is valuable. So when the price drops, you smile. It's a discount. It's a bargain. Final thoughts. Look, we have covered a lot of ground today. We've talked about the myth of the crystal ball, the reality of fundamental analysis, the power of index funds, and the psychology of market movements. But the most important step? Taking action. I've left all the resources you need in the description below. If you want to dive deeper, if you want to master these strategies, you need to stay connected. Do not click away yet. We have so much more to cover in future videos. Make sure you are subscribed to The Money Game. Join the family. Engage in the comments. I want to hear from you. Which of these strategies are you going to implement today? Which one resonated with you the most? Tell me in the comments below. Share this video with your friends and family, the ones you actually care about, so they can stop losing money and start building their future. And make sure to hit that bell icon, because when a new The Money Game video drops, you need to be the first one to see it. You have the tools now. You have the knowledge. You have the strategy. Now, it's up to you to apply it. The game is played, and it's time for you to win. I'll see you in the next one.